Hello and welcome to our webinar today. We're going to be talking about promoting transparency and managing risk. And this is a webinar we've put together for the Office of Grants Management. I'll be your host today. My name is Sarah Jackson. I'm a loan officer and financial specialist with Propel Nonprofits. Propel Nonprofits is a nonprofit organization based in Minneapolis. Our mission is to fuel the effectiveness of nonprofits with guidance, expertise, and capital. So we're here to help and work with all of the nonprofits across the state of Minnesota and our neighboring states. So if you ever have questions following this webinar or something else arises in the future that we could be of assistance with, please don't hesitate to reach out. But let's jump right into our content today. We have a few goals for today's session. We will be reviewing the characteristics of financially healthy nonprofits together. We're hoping that you'll understand the importance of financial policies, procedures, and controls after the webinar, and we'll also discuss the effective use of external review. So, big question, what is financial health? Well, we believe at Propel that financial health involves 5 really key characteristics. So that includes having the mission, vision, and finance all aligned together, having clear roles and responsibilities for staff and board and volunteers, having an effective planning process, having disciplined financial management practices, and also a commitment to policies and actions that foster accountability. The first thing that we'll touch on today are financial policies, procedures, and controls. So one of the things we're talking about today is risk management. So the question arises is, what risks do nonprofits face? Well, many, I guess. Fraud is a potential risk to nonprofits. It's not prevalent in the nonprofit industry, but it does happen. And one of the things we will talk about today are just ways that you can put policies and procedures in place to prevent things like fraud from even happening in your shop to begin with. Another risk is having too much reliance on one employee. I think we all understand the challenges and struggles that small nonprofits face when there just aren't a lot of staff around to help out with different responsibilities. This can become a risk, but again, if we have great policies and procedures in place, we can mitigate that risk. Not having policies in place is another risk. And of course, that's a big thing we'll touch on today. And also high expectations. I think that there's high expectations of board and staff in nonprofits to perform at a high level, and sometimes that can create risk. Again, we'll chat about how we can mitigate that risk today. So the first thing that we suggest doing in this sort of process is to assess risk. Now this can be conducted in a formal or informal way, but the first thing we'll want to do is kind of take stock of some different areas in our nonprofit and then figure out how we can best create policies and procedures to alleviate any pain points or fix problems that we might see. So when we talk about risk, what are potential losses of risk and how can we evaluate or assess some of those risks? So if we start with financial assets, this is something we'd want to look at in terms of, do you have cash on hand in your office? Is it locked up? How do you handle the handling of cash out at an event, like if you have a bake sale or you have donations at an event? How do you protect financial assets from a policy standpoint? Who has access to accounts? Are there passwords protecting your accounting software? Things like that. Physical assets. So these are the things that our organization owns. So you might want to think about, is your office locked? Is it open during the day? Is it closed? Are computers readily accessible? Could someone come into your office in the middle of the day and grab a few laptops? Are your files secure? Those are all things to consider. Now, human resources. Of course, we all know that humans are the biggest resource at our companies, at our nonprofits. And so we want to think about the environment in which our people work. Is there concerns about mold or water in the office you work in? Are there other safety concerns? We can also, as we talked about earlier with fraud, kind of take steps to eliminate slippery slope situations where an employee might be tempted to steal money or write a check to themselves. The next is ability to operate. So a potential risk in that area would be just kind of the separation of labor or that kind of thing in your office. So if you have rules that require, let's say, 2 people to sign checks, but regularly you only have 1 person in the office, that might be a policy you'd want to reconsider because it's sort of hindering your ability to operate on a regular basis. You don't want to create any impediments to your operations. You want to sort of optimize your operations. The next piece is reputation and credibility. When we're thinking about things that could be lost, if there is a loss to financial, physical assets, a threat to human resources, you do definitely risk losing reputation and credibility within the community. That could also lead to the loss of donors and tax-exempt status. Especially around tax-exempt status, we want to consider, are we filing reports on time? Are you registering regularly with the Secretary of State and the Attorney General? So those are all things to consider as you do a formal or informal assessment of risk in your organization. The last thing to think about is who is responsible for risk management. And that will be laid out in the policies and procedures that we talk about as this webinar continues. But I think the answer here is that everyone is responsible for it in different ways. And we'll get into more detail about who is responsible for what. So we talk about a hierarchy of financial controls. And one of the things we mentioned earlier in sort of the characteristics of a healthy nonprofit is one that has its mission and values in line with its financial policies. And so you'll see that financial controls are all really based in the mission, values, and culture of the board. And so that is sort of the top of this pyramid that you're seeing here. The next step down is board adopted policies. So these are the broad reaching sort of direction in which you should head, followed by procedures and systems, which are often created and carried out by staff members. And at the bottom, you'll see internal controls. And this is really the nitty-gritty of preventing risk, and mitigating risk, and harm to your organization. And we will talk about each of these different pieces in depth as we continue here. We're going to start first with board-adopted policies. So quite simply, policies are a written description of responsibility, accountability, and authority for decisions and actions. Each nonprofit organization should have a grouping of essential policies on file. So the first and maybe most obvious would be bylaws. So the bylaws are really a foundational and operational document for your organization. It lays out how many people need to be on your board, when your annual meeting might be held. It could lay out things like who can take out loans or open bank accounts for your organization. It really lays the groundwork and sort of the base layer of rules for your organization. The next policy we talk about is a conflict of interest policy, which is sort of self-explanatory, but that is a policy that should definitely be reviewed and read and then signed by both the board members of your organization and key staff. Another essential policy would be an employment policy. So that policy would really lay out the information that your employees need to understand about operations. So what does your work week look like? What is your paid time off policy, sick leave policy, things of that nature? It might also get into how you request and have approved expenses for the organization. An employment policy is something you'll probably want to work with an employment attorney or an HR professional. You'll also have a whistleblower policy. So this would lay out who staff members or board members could go to if they find wrongdoing in the organization. They'll have a guide for who to talk to and what to do in that situation. And finally, and perhaps most importantly for today, is the financial policy. And we're going to walk step by step through financial policies. So why should we have financial policies? Well, it's pretty easy. It makes the responsibilities clear for both the staff and board. So who is in charge of what? We have a great understanding of what that means. It also helps manage risk for the organization. It also assures oversight of financial matters. When you understand who is in charge of what and who's doing what, you have that assurance in the organization. It also promotes efficiencies in operations. This is an area where I always suggest if you have an outdated financial policy, it might make sense to update it and maybe think about if there are any efficiencies or sort of optimization you can build into your policy. Just because you've always done something one way does not mean you have to continue to do it that way. But if you do change the way you're doing things, it's great to update your policy as well. It also minimizes risk of loss in assets or reputation. So a lot of the steps we're taking in this policy, it provides a guide and sort of a how-to of how to do things, but it also minimizes risk along the way because we're making sure that there is separation of responsibilities and that there's a lot of oversight at all steps. And finally, it also protects staff from overexposure to risk. Financial policies should always include 4 key things. First of all, it should lay out who has authority, so who decides. It should also lay out who has responsibility and who is accountable. Next, it should always have management policies so that you know what to do. And finally, guidelines, so boundaries or limits. And we're going to get into each of these 4 pieces pretty in depth here next. We'll start with authority. So a financial policy should always include who has the authority to do things like set salaries, benefits, and compensation. Also to sign contracts, loans, and leases. To approve expenses or sign checks. And to approve variances in the budget and also to invest funds. So those are all financial practices of the organization, and that this policy would lay out who has the authority to do these things. It may not be the same person that has the authority to do each of these things. Perhaps there are multiple people in your organization who would be able to approve expenses and sign checks, but only the executive director could invest funds. Or maybe only the finance committee can invest funds. So that's what a policy would really do a good job of outlining for you. Next, we'll move on to responsibility. So financial policy should include who has the responsibility for reporting and oversight. So that would include who is in charge of entering checks and putting information into your accounting software, who's in charge of creating monthly financial statements and when are those due. It really lays out the reporting and oversight tasks. It also lays out the completion of financial tasks. So this is maybe a little different. Who is in charge of your cash flow projections? Perhaps who's in charge of running your capital campaign or other fundraising efforts that are taking place. It also lays out who has responsibility for reporting and compliance. So this would be, who is in charge ultimately of filing your Form 990 with the federal government every year? Who is in charge of making sure that your registrations with the Attorney General and the Secretary of State are up to date? It would also include reports to philanthropy. So if you have an ongoing grant with an organization, it just lays out responsibility for who is in charge of doing that reporting, making sure you're in compliance. Finally, and maybe most importantly, financial policy should lay out who is in charge of implementing internal controls. And again, we are going to talk sort of more in depth about internal controls in a little bit, but internal controls are really a key way that we can control and mitigate risk in our organizations. Next, we'll move on to management policies. So a financial policy should include the following management policies. So for fixed assets, we would talk about perhaps the threshold for making something an expense versus a capitalized item on your balance sheet. So perhaps purchases up to $5,000 are an expense, and if an expense is an item you purchase is over $5,000, that's your capitalization threshold. So that would go on your balance sheet as a fixed asset that is depreciated. Similarly, for investments, many organizations have a separate investment policy which would lay out sort of goals for returns, a spending policy, guidelines for the purchase and sale of different investments. This is usually managed by the board of directors or the finance committee. The next area of policy would be for financial reporting. So this would outline who must do it, so who must create the financial reports every month, what the timeline for those reports would be. For example, are you required to have your financial reports done by the 15th of the next month or something like that? The same would go for budgeting. So what is the timeline for your budget cycle? When is the first draft of the budget due? When must the budget be approved? Always before the first part of the next financial year, of course, but those might be some things that are laid out in your financial reporting policy. The next area we would consider is gift acceptance. And a great example here would be if you are gifted the gift of stock, for example. So you would want to develop a policy for what to do in that situation. Many organizations require that after you accept the stock gift that it has to be sold immediately, and then the cash is added to your savings portfolio. And the last piece is for cash reserve. So it's great to have a policy about cash reserve. It's wonderful when an organization has a cash reserve, but this policy would lay out how much cash that you'd like to have in reserve. Maybe that's a day, X numbers of days, cash on hand, a month of operating funds, or perhaps it's just a dollar amount. And that could change year to year also depending on the state of your finances. The last piece of a financial policy are guidelines, and these are very straightforward. So a financial policy should include guidelines for purchasing, bidding, and vendors. So there might be a threshold or a dollar amount of when you'd need to put a project out for RFP, or you could just make a purchase with a vendor. Guidelines for travel and expense reimbursement, for use of consultants and contractors. Guidelines for budgeting, that's very important. Again, that would sort of lay out the timeline for your budgeting process and who's responsible for what. Another piece is for allocation and distribution of expenses. So this would be how you allocate expenses in your organization to what department or what program. You might also allocate things by their nature. So you may have a division for travel, you may have one for meals, you may have one for supplies, things like that. And then the last guideline would be for insurance. So that would be property insurance, directors and officers insurance, other areas where you might need insurance. It's great to have guidelines for that. We have a great resource to share with you at Propel. So we've actually created a sample financial policy, which the first page of our example really lays out the 5 essentials that we just talked about and some different considerations you can think about when creating a financial policy or updating your financial policy. And then the next 2 pages provides a great example policy for you to look at. It's very simple. It's easy to follow, and it really tracks closely with all of the pieces we just talked about. If you go to our website, propelnonprofits.org, and search for sample financial policy, you'll be able to download this file, and it's a great tool. So now that we've talked about policies, let's talk a little bit about policies versus procedures. So policies and procedures, while they're similar, they are not exactly the same. So policies are statements on end results, while procedures are specific statements on how the end results will be achieved. Procedures are the nitty-gritty, the how-to, and policies are sort of the overarching goal statement for your organization. We'll talk about a few examples just to kind of really solidify this idea. So a policy would be that mileage shall be reimbursed at the current IRS rate. The procedure for that policy would be that all non-local travel shall be approved in advance by the employee's manager, or the expense may not be reimbursed. And staff shall submit mileage reimbursement requests by the 25th of each month on the prescribed form. So that lays out very clearly how the procedures needed to meet that policy item. The next policy example would be, and this is a bit long-winded, but donated stock shall be sold immediately upon receipt. The value of gifted stock provided to the donor for gift purposes shall be the average of the high and low of the stock on the day in which the legal ownership was transferred from the donor to the organization. The procedure would be that stock donations shall be processed through the organization's account at Charles Schwab. So it gives the broad sort of policy statement about what we do with donated stock, and then provides the procedure example of that. It's processed through our investment account right away. So now we're going to move into some of the more nitty-gritty, and this would be the internal controls for the organization. So internal controls are a component part of policies and procedures, and like I said, it really kind of gets into the fine detail of how to act out the procedures properly. Internal controls are needed for all cash transactions. So this includes the receipt of funds and bank deposits, the approving bills and signing checks, reconciling bank accounts, invoicing and collections, payroll, grants and contributions, and accounting. So these are all areas where we want to make sure that there are multiple people helping out and that there are documented steps that we can take to make sure that there isn't the threat or risk of fraud in the organization, and that no one person holds all the power. So I know this can be a challenge in small organizations. I've worked at small and medium-sized organizations, and oftentimes to create internal controls, we do have to invest the help of other people in our organization. So you may have a bookkeeper or administrator, someone who does operations at your organization that is primarily in charge of accounting responsibilities, but perhaps you enlist the help of a program person or a salesperson and just another person on your staff. It could even be an intern that can help break down some of these steps and have another person be part of the cycle. The main point is that we don't want any person to be in charge of it all, and that the separation of duties really helps us to not rely just on one person. Well, let's talk a little bit more about how we can do that in our organizations. So we talked a little bit about segregation of duties. So what we encourage all organizations to do is to develop procedures to prevent any one person from controlling all aspects or all steps of a financial transaction. So what you'll want to do in your organization as you're thinking about internal controls is to document the different steps of each process and then identify practical ways in which you can break the chain. So I'll read here the sort of different steps that one might go through for these financial transactions, and then discuss a little bit about how we could break the chain in these situations. So the different steps we might take are prepare invoice or pledge reminder, receive and open mail, prepare bank deposit, enter receipts into accounting system, make journal entries and adjustments, receive bank statement, reconcile bank statement, and prepare financial reports. So I think it's really easy to consider a situation in which there's one person on staff that would do all of these things. But we could maybe consider ways in which we can insert other people into these tasks to break the chain. So perhaps instead of having the bookkeeper receive and open the mail, the executive director receives and opens the mail. And the bookkeeper would prepare the bank deposit, but with perhaps the help of the staff assistant. There is probably one person who would enter receipts into the accounting system while you have another person make journal entries and adjustments. In my last organization, we had sort of a staff assistant who worked in tandem with our accounting manager. So our staff assistant would do things like receive and open the mail and make copies of checks. And then together they would prepare the bank deposit. Whereas the staff assistant would enter receipts into the accounting system and invoices, and then our accounting manager would go through and make entries and adjustments, reconcile the bank statement, things like that. So just because you only have one finance person on your staff or one administrative person on your staff doesn't mean we can't think of creative ways to sort of break this up. We have this is a list that you can make when we talk about documenting all the steps that you might take in your finance department. You can create a spreadsheet that really has all of those duties listed. So for example, on our list here we have approve and sign contracts, send invoices and collect, open mail, log checks and cash, prepare bank deposit, take deposit to bank, post funds received to accounting, prepare checks for payments, post payments to accounting, sign checks, open bank statement, reconcile bank statement, approve employee time records, prepare payroll checks, prepare payroll tax reports, prepare financial reports, and file IRS and state reports. So that is a long list of duties. But what you can begin to think about is to create a list like this for your organization, and then create some more columns with whose responsibility that could be. The main thing is that we don't want the same person in charge of every single one of those items. We want to make sure to mix it up and to break the chain a bit. So let's talk a little bit about the difference between the financial responsibilities of the board versus the responsibilities of the staff. So we'll start out with the board. So the board's responsibility is to adopt strategic plans and goals for the organization. Again, the board always has the mission and vision of the organization as sort of the highest guiding document in their work. They're also responsible for creating and maintaining an appropriate governance structure. So again, we talked about the importance of bylaws as a policy. That's your main governance document. So the board is also responsible for making sure that they're following their own bylaws. Are they the right number of board members? Are there the right number of officers? Are they meeting on the schedule required by the bylaws? Those are all things that the board is responsible for maintaining. And the next piece is the board is responsible for adopting policies for financial practices and activities. So all these things we just talked about, it's their responsibility to adopt the policies and practices for our financial health. The next piece is the board should ensure adequate staffing. Obviously that would go into strategic planning, strategic vision for the organization, and also it ties in with budget. And finally, approve the annual budget, understanding assumptions, priorities, and risk. So while it's often the staff's responsibility to create drafts of the budget, ultimately it is the responsibility of the board to approve that budget. Let's look now at the responsibilities of staff. So the staff is responsible to prepare and plan, to comply with board direction and decisions, to follow adopted policies, to develop and use procedures and practices, to monitor progress and make decisions within framework, and to provide accurate and adequate information. So I think you can kind of see here that the board is really in charge of the strategic vision and direction of the organization, while the staff is really tasked with the sort of detailed nitty-gritty work of the organization and making sure that the sort of vision that the board creates for the organization is carried out in the day-to-day practices of the organization. That's also sort of demonstrated in this image here. It shows the difference between board and staff roles. The board is really Their sort of wheelhouse is mission, goals, strategy, and policy, whereas the staff is in charge of planning, implementation, evaluation, and communications. The board is high level. They're guiding the vision of the organization. They're making sure that everything is staying on track. The staff is doing the hard work. They're on the ground planning and implementing all of the policies to make sure that the actual day-to-day work of the organization is done. Let's talk a little bit about board oversight of the budget. So as I mentioned earlier, the board is not necessarily responsible for creating or drafting the budget, but they definitely have the sort of charge to approve the budget. So in that, the board should definitely, or there's a board, the finance committee, a budget committee, should set a target date for board approval of the budget. And we always recommend that the approval happens before the beginning of the fiscal year that the budget is for. So that requires kind of taking a step back and allowing time for each step of the budget process to happen and for there to be enough time to have a thoughtful review of the budget draft and discussion moving forward. At Propel, we talk about a beautiful 10-step process of budgeting. And as you can see here, the highlighted in the darker color gray are the steps of that budget process where the board is really expected to help. So the board and the staff may determine the timeline initially, but the board will definitely have to agree on the goals of the budget. So is this going to be a growth year? Are you expecting a deficit because you are investing money in new programs, or you are hiring a new staff member? Is this going to be a big surplus year? Maybe you are in the midst of a capital campaign. Maybe you're planning on moving your offices or purchasing a building. So it's important that everyone really agree on the goals of the budget at the outset. Part of that is understanding the current financial status of the organization. So that would mean digging into the actuals of the last year or perhaps the last few years, understanding what changes may be lying ahead, maybe doing a little risk analysis. Is the market going to change? Are you expecting staffing changes? So just really understanding the current financial status of the organization. And then you should agree on the budget approach. So again, that also harkens back to that idea of what kind of budget are we having? What are our goals? What are we aiming to do here? And then the staff will draft an expense and income budget for you, for the finance committee or for the board, probably in partnership with the finance committee. I see most often that finance committees are involved in that budget process. Then it will kick back to the board to review the draft budget and eventually approve the budget. And then kind of going back to that place where it's really the staff's responsibility to get into the dirt and do the work. The staff will document budget decisions and then implement the budget. And then in 6 months, it all starts over again. One of the last things we'll talk about today is the effective use of external review. And so what is external review? Generally speaking, it's an audit or a different service like that provided by a CPA. So there are 3 levels of a financial report that are prepared by a CPA. The first thing I'll mention, and we'll just go to the bottom of the list to start, is that an audit is required by law in the state of Minnesota for any organization that has a budget of $750,000 or greater. So in many cases, an audit would be the choice for the organization as far as an external review is concerned. But for organizations that are smaller than $750,000 per year, there's a few options. One would be a compilation, and that uses information from the organization with minimal review from a CPA. So this might mean that the organization would send their year-end financial statements to the CPA. They would do some reviewing, and then they would create the compilation report for you. A review is a little bit more intense than a compilation. This subjects the organization to more scrutiny by a CPA to verify the information. So this might mean a full review of every single month-end statement. Might mean a little bit more digging by the CPA. It's good to have these, and some funders require organizations of any size to have at least a compilation or a review when they submit their reporting at the end of the year. That would be something to ask your funders if that would be something that they require. And then finally, as I mentioned earlier, the audit is the most in-depth review. This is where there is balancing and testing done to ensure that the information, your financial information, is correct. This is the highest level of review by a CPA. And so an audit is really a great tool to make sure that not only is your financial data correct, but they will review your policies and procedures. They will make sure that your internal controls are solid, and often make suggestions for changes for the future to strengthen those practices. The board of directors is actually charged with hiring an auditor. So auditors are hired by the board of directors, and sometimes you'll have an audit committee as sort of a subcommittee on your board, or your finance committee could take care of this. The organization or the board of directors would be in charge of selecting an audit firm. And so we sort of suggest that you put your audit out to bid or RFP process about every 3 to 5 years. It's always good to kind of change audit firms and have a fresh set of eyes, look at your organization, especially if you've been through a lot of changes or leadership has changed. It's always a good idea to have a fresh set of eyes on your information. So the board of directors then would be in charge of that RFP process. The last piece about communicating with your auditor during the year. So communicating with your auditor throughout the year may have been more common a while ago. Now you really are billed for every interaction you have with your auditor. But some reasons you may communicate with your auditor are perhaps to change the scope of the work. So let's say you signed up for a review and now you want to go full audit, or you're tacking on the preparation of a Form 990 or something like that. Those would be perfectly reasonable things to reach out to your auditor about during the year. The last thing we'll talk about here in this section is just the components of an audit. So and if you've never looked at an audit, they're actually quite interesting. They contain a plethora of information about the organization. And I believe we do have case studies or examples of auditors' reports on our website that you could search for. But these are the main components of an audit. So the first piece is an opinion letter, and this basically lays out to the board of directors what the auditors have done. They'll say what they have reviewed, what standards they have used for that review, generally speaking FASB or GAAP financial standards. They will give you an opinion of their experience, whether the audit has turned out well. They may mention at the top if there's a going concern on your audit. So the opinion letter is just kind of like the cover letter to the financials. The second piece of an audit would be the statement of financial position, which is also known as your balance sheet. So this is the statement of all of your assets and liabilities for the organization. So it will say how much money you have in cash. It'll show any loans you have for the organization, things like that. The next piece is a statement of activities, or the income statement. So this will show all your income for the year, both revenue and contributions. It'll show your expenses, and it normally does break out expenses into program administration and fundraising, which is also required for your 990. The next piece is a statement of cash flow, so it explains where your cash went throughout the year. And the last piece is a statement of functional expenses. Not the last piece. The actual last piece are the note disclosures. And this is what I think is a very interesting piece of an audit, where you can really learn a lot about an organization. So Many audit note disclosures contain information about the mission and programming of the organization throughout the year. It'll also talk about if you have debt, if you own a building. It'll explain if you have, for example, if you're doing a capital campaign, it'll lay out long-term donations and pledges, things of that matter. It just really tells an interesting story about the organization through its financials. And if you haven't ever picked up an audit and looked at the note disclosures, I do suggest it. You really learn so much. So the last thing I have to offer you today is a financial health self-assessment. So this is another resource that you can go to our website, propelnonprofits.org, and search for the Financial Management Self-Assessment. So if you're like me a few years ago when I was in your seat as a leader of a small nonprofit organization, I might have watched this webinar and thought, whoa, we're just not doing any of this, or we don't have a financial policy, or we don't have a gift policy. And so what this assessment will help you do is kind of get started on the process of figuring out where you're at, where you might have weaknesses, where your organization is strong, and then you can lay out sort of a plan for improvement. So it asks questions like, do board members clearly understand their roles and responsibilities for financial health? Do you have qualified and knowledgeable staff or volunteers who are responsible for accounting records? Is your budget reviewed by the board and approved before the fiscal year begins? So it's a set of 20 different questions that you can look through. Perhaps maybe you would like to do this self-assessment, or you could bring it to your executive director or your board of directors and really get a feel for where your organization is at. And again, once you have an assessment of where you are, I do encourage you to also download the Nonprofit Financial Policy Guidelines and Example, because that would be a great starting point for you to begin to do some work on either updating your policy, or if you don't have one yet, creating a new one. So I do hope our time together today has been valuable. As I mentioned earlier, Propel Nonprofits is really here to serve the needs of all nonprofits across Minnesota. And so if you have questions following this webinar, or if you would like to follow up with any of Propel's services, please don't hesitate to reach out. And you can find us and contact information for both me and all of our teams at www.propelnonprofits.org. I hope you all have a great day. Thanks for tuning in.